We are now 48 hours away from knowing what the Fed is about to do and the effects that it will have on the markets. And in this video, we are going to be addressing this. So welcome to the channel, everyone. My name is Nick. For those that are new to the channel, hopefully by the end of this video, you do become a subscriber. If we take a quick look at what is happening. Yes, the FOMC meeting is here. It begins on September 17th. But the 18th is where we get all of those major decisions. And this will definitely have substantial effects on the markets. In fact, this entire week is going to be filled with a ton of volatility. In fact, right now, if we go over here, we can see that the Federal Reserve now likely to cut interest rates by 50 BPS at this week's FOMC meeting. Now, personally, I would love to see 25. I feel as though that is pretty subtle. 50, it definitely indicates that something is broken, which would mean a negative effect on the overall market. But outside of just the FOMC meeting, we also have some key events to focus on this week, including, of course, the August retail sales data, the building permits data, the Fed interest rate decision, which does happen on Wednesday, like I said, the Fed press conference, which also does happen on Wednesday, Philly Fed Manufacturing Index on Thursday, followed by the existing home sales data as well. It is officially Fed Week, and yes, it does come with substantial volatility. The best way to prepare for FOMC meetings or FOMC weeks is to have stablecoins on the sidelines. And I typically like to buy, a day or two after the dust has settled. So, if we do start to see some major, swings in the market, definitely kind of sit back. Try to relax and try to keep emotions at the neutral territory. But beyond this, let's actually talk about some things to focus on. Number one, Warren Buffett. We've been hearing a lot about Warren Buffett selling a ton of stocks around Apple, for example, and now also Bank of America. He sold another $1 billion of Bank of America. And this is, making people think that, oh, banks are done. Banks are finished. They are screwed. Now, again, one thing that I really kind of take from this is we are starting to witness drama building up around markets, fear building up around markets. Everyone is at that point in time where they're just like, nothing is going to save us. We're just going to continue to sell off. We are now officially in a recession. That's it. We're done. I want everyone to understand that I personally believe that we're already in a recession. What we are witnessing right now is capitulation of the markets before one of the biggest swings to the upside, in my opinion. Over here, we have JP Morgan. Chief Jamie Dimon has warned U.S. economy faces an outcome worse than a recession. I would say the worst outcome is stagflation, recession, higher inflation. Now, a lot of people are going to say, well, JP Morgan, Jamie Dimon, they have pushed nonsense in the past where if we did the opposite, we'd make a ton of money. I actually do believe that Jamie Dimon is 100% correct on this, but the problem is the time of this, right? When is this actually going to happen? And everyone right now is still pushing some bullish charts around what the Fed is doing, but also we are seeing some fear mongering. In fact, I believe that we see more fear than bullish, news and bullish outlooks when it comes to what the Fed is about to do. Over here, we have the Fed is about to cut 50 BPS in 4 days from now. Again, remember what I said, 50 BPS is technically bearish because it would highlight something going wrong. Remember the last time they cut rates, the bull market started. This is super bullish for Bitcoin. Now, the problem here is everyone is looking at this and they're looking at it in a way where it's only one path forward, which means we have to crash or we have to pump hard. I want to show you guys a chart real quick. Here we have the Federal Reserve and financial crisis. This shows us everything around recessions, the federal funds effective rate, the Fed funds exponential growth trend, the S&P 500, and also rate cuts. Rate cuts are in red. And if we look at this, we could see the first official rate cut on this chart going all the way back to like roughly 1981. And we could see what happened right after. We saw a significant sell-off on the S&P 500. You might not say that it's that significant, but it was significant. But from that point on, it did start to bounce. But remember, this is a lagging factor. It started to bounce up until 1985 or 1984, technically, when we saw the next major cut. Again, markets went up in value instead of selling off this time. Then we get another rate cut. That's around roughly like 1989. We have a little bit of a flat line on the S&P 500, and then we sell off, and then we go crazy during the dot-com bubble, and this happens all the way until roughly like 2000. 3 rate cuts in between there, nothing too substantial until the last one, where a recession hits. And it was a slight recession. We sold off heavy in terms of the S&P 500, one of the worst sell-offs in history, as you guys are probably all aware. And then we pump into the 2008 crisis. Here we have like 2007. And then, boom, we crash. There we have the credit crisis. S&P 500 crashes heavily. Everyone's panicking and so forth. Then we go all the way to 2020, where we did see another rate cut. But do you guys see what happened? We get the rate cut, and they technically said that that was a recession going off of this chart from Real Investment Advice. But we sold off heavily on the S&P 500, and then we rebounded. So when we think about bullish or bearish, yes, we can be in a territory where we are about to pump heavily. But don't overlook the short-term pain, max pain. That could happen. Everyone seemingly wants the Fed to cut rates. There is a widely popular theory that a Fed pivot is good for markets. It is patently false. After the Fed pivot to rate cuts, the market almost always crashes and corrects. Rate cuts generally precede major dips. Let's look at history: yield curve inversion, then normalization, blue, Fed pivot, red, recession, bear market, and bottom, black. Maybe this time is different, maybe not. And here we have the pivot. We have the area of pivot. We also have the yield curve inversion, and then also the recession, as you guys can see. So the pivots are in red. We have one here back in roughly like 2000 or so, back in 2007, just like I outlined. We also have one in 2020. And if we are about to see yet again another one here, it is questionable on what happens next. Are we going to have a sell-off, or are we going to pump? Because what could happen now is a major correction, then we pump. Everyone is only expecting up, which is a big problem. Even over here, we have 4 days until the FOMC meeting, where Powell will likely cut by 0.25. Odds are currently 50% for 0.25 and 50% for 0.5. The similarities between 2007 and 2024 are wild. Charts and comments. And yeah, this is actually a very good insight. Now, this is pretty bearish technically. We have this post is not calling for a 2007 crash. I'm simply pointing out the intriguing similarities in timing and economic indicators. And yes, it is very similar. I will say that right now. But the big thing to focus on here is what happened leading up to 2007 and what happened so far leading up to where we are at currently. In fact, the number one thing that I want to take from all of this is just how parabolic things went leading up to the crash in 07 into 08. We have yet to actually see that happen around these markets. And I know that you guys are probably going to say, well, what about stocks? Yeah, technically stocks had a nice run up, but we haven't really seen anything crazy happen where it would justify a massive crash and like a 07, 08 like, massive move to the downside. But over here we have this week is going to get exciting. Powell is expected to announce a rate cut during Wednesday's FOMC meeting with a 50-50 chance of either a 0.25 or 0.50 reduction. Get ready for the mega crash. Everyone is almost expecting a major crash. That's why I do believe that we probably correct a little bit and then we pump. And the reason why I say this because I know that you guys are going to say, well, Nick, I don't understand what you're calling for. You outlined, multiple areas in time where we did correct and crashed. Yes, I did. But the problem here is that there's a lot of negativity around the Fed cutting rates. If we do have a crash, in my opinion, it will be a correction that everyone will call for much lower price action, a much larger crash. They're going to be calling for a 2008-like crash or a 2000-like crash. I think this time, when it comes to a Fed cut, we will probably correct slightly. Everyone will overreact, and then we will go parabolic. And I want to go back over here to what Jamie Dimon from JP Morgan is telling us, right? He's warning of a US economy facing an outcome worse than a recession. Okay, well, now we have this. We have the Fed potentially cutting rates, which is building for a perfect storm for everyone to overreact and get shaken out at a time where I do believe we should be focused on what happened during 2020. Big shout out to Zahir over here from Split Capital. We have crypto cares much more about federal interest rates than it does about liquidity being injected into global economy. Plus 7 billion in market cap since late July and before the first round of cuts, 500 billion within 2 years in a constructive regime. And here we actually have stablecoins in crypto, the liquidity source for everything. Here we have crypto is an incredibly rate sensitive market, but not for the reason people think. Today's understanding of crypto expansion is rooted in the idea that crypto trades as extremely long beta, but stablecoins, the killer feature of crypto, doesn't share the same view. And here we have rate cuts to zero back in March of 2020. And by the way, this is stablecoin growth. First rate hike in March of 2022. Killing the cycle for crypto, killing crypto itself. At that point in time, crypto was already topped out from November to like roughly December, because there was a few altcoins that still ran into December of 2021. But during that time, the market was already dead, and then this just really kind of killed it completely. But we have the end rate hike cycle back in July of 2023, and from that point on, we saw the market going absolutely parabolic. Now we're starting to see the start rate of the cut cycle. If this is to repeat, and if we do see something like March of 2020 into something like March of 2022, things are about to get very, very interesting in a very bullish way. We have stablecoin expansion is predicted on three things: global dollar shortage, ease of transacting, crypto leverage, and yield. The first two reasons are often noted as the bull case for stablecoins, but realistically, a more interesting angle is crypto leverage and dollarization. Today, stablecoin supply is barely over all-time highs, while asset prices have largely reached past their prior peaks. Part of the reason why this is the case is due to the fact that there is a higher cost and risk of capital placed in USDC and USDT than dollars in a bank. If you're able to collect 5% at the bank relatively risk-free and with some decent insurance, there is likely little incentive to move money on-chain, not to mention the added smart contract and capital efficiency hassle. Yet, we are entering a rate cut environment for the first time in roughly 4 years, and the yield of being on-chain is looking attractive again. Coupled with a likely pro-crypto admin, I believe are on the brink of a massive stablecoin expansion in the coming months. And yes, if we think about this, combined with everything that we've been hearing about stablecoins and stablecoin regulation, I do believe that we could very well start to see a massive bullish environment for crypto, for stablecoin growth. And, this is where we start to see the talks of, all right, well, when is alt season going to happen? When is the bull run going to continue? Well, we don't get to the bull run and we don't get to the alt season without a substantial shakeout. So, like I said, I do believe what we will see here is a correction. Everyone overreact, pushing FUD, pushing this, pushing that, just for everything to rebound. We have the perfect storm in front of us. We have Jamie Dimon getting fearful. We have Warren Buffett selling massive amounts of banking stocks and stocks in general. We now have the potential, Fed rate cut where everyone is already doom and gloom around some charts going back to 2008 and 2000 at a time where money market funds are sitting at about $6.32 trillion. Okay, 2.6 trillion is retail money. 3.8 trillion is institutional money. So think about how much money is sitting on the sidelines. I don't know about you guys, but money market funds hitting all-time highs doesn't sound very compelling to justify an 08-like crash. This is like unheard of when we are talking about a recession or, a 2008-like crash. money market funds hitting all-time highs is a big indicator that we're not about to crash. We're not about to have a recession hit yet, which is also what I told you guys going back to the 13th when I did quote the JP Morgan article where I said I agree with Dimon. However, there is over $6 trillion in money market funds sitting on the sidelines. Max pain is markets melting up while the money on the sidelines starts pouring in, buying the top right before the meltdown. And yes, this is money that gets intrigued when markets start to go parabolic. So if crypto starts to go parabolic and this money is starting to buy in and pushing the prices even higher and higher and higher, all of a sudden, you know, we have a ton of money buying the top, and then all of a sudden we melt down. And that money that was parked on the sidelines in money market funds, which are fairly low risk, are now in crypto at a time where the markets are turning and about to crash, wiping out all of that money. That is max pain. This feels oddly similar to the 2008 crisis, but it will definitely be worse. In my opinion, don't forget to take profits. And yes, that's the number one thing that I want to stress to you guys. Because if we are about to enter this area, just like, 2020, things are about to get wild. So focus on the big target here. The Fed could very well soon be about to make us very, very rich, especially with what they decide on Wednesday. So with that being said, I hope that you guys enjoyed this video. If you guys definitely leave a like, subscribe, turn notifications on because more free content. You guys are more than welcome to follow me on Twitter and join the free Discord down in the description below. And with that being said, guys, it's been Nick. Thanks for watching. Peace out.